Welcome to Capital Thinking, energy insights for today's market, presented by Stephens Inc. and Thompson & Knight. The natural introductory topic for the inaugural Capital Thinking, Energy Insights for Today's Market is navigating the private equity landscape during a pandemic and beyond. In addition to COVID-19's impact on the industry, we will dive into acquisitions and divestitures, competition for deals, transition trends regarding evolution of energy sources, as well as evolution of the investor base, how the upcoming U.S. elections may impact investment strategies, and finally, the outlook for a recovery in energy markets.
Hello, I'm Keith Behrens, Head of Energy Investment Banking at Stephens, and welcome to Capital Thinking, Energy Insights for Today's Market. This virtual thought leadership webinar series explores the challenges and opportunities affecting the energy industry. Fortunate to have a true expert as my co-host, Holt Foster, who's a partner at Thompson & Knight. Holt is on numerous prestigious top lawyer lists, including Woodward White's Best Lawyers in America, Legalese is the Legal 100 United States, and D Magazine's Best Lawyers in Dallas. Holt has extensive legal experience in private equity, M&A, and energy finance. Holt, thank you for joining me.
Hey, Keith, I am glad to be here. And on behalf of Thompson Knight, we are very happy and proud to co-sponsor this. I think we got a great lineup and going to cover some very interesting topics. But candidly, I think our audience is much less interested in hearing you and me talk than hearing what our expert panelists have to say. So why don't you do the honors and introduce them?
With us today are Kyle Kapka, partner at EnCap Investments. EnCap, founded in 1988, is a leading provider of venture capital to independent energy companies.
Hey, Keith, Holt. Thanks for having me, Billy and Jason. Look forward to the discussion.
And we have Billy Quinn, founder and managing partner at Pearl Energy Investments. Founded in 2015, focuses on partnering with best-in-class management teams to invest in the lower to middle market upstream, midstream, and oil field service sectors.
Hey, how y'all doing? Thanks for having me. Looking forward to this.
Okay, we have Jason Downey, co-founder and managing partner at Tailwater Capital. Tailwater, founded in 2013, is a growth-oriented middle market private equity firm focused on the upstream and midstream energy sectors.
Thank you, Keith, and thanks, Holt. Really appreciate you guys doing this, and happy to be able to be here with you today, and happy to be able to hear what my peers Billy and Kyle have to say as well. I look forward to this conversation. Thank you very much.
Holt, you want to kick us off and talk about what's on everyone's mind, the pandemic?
Sure. What a year 2020 has been so far, and we still got a quarter left to go. I don't know that we know what the long-term impacts are, but it seems that every day, every week, every month, that there's a new curveball that's impacting everything across the country, be it mass gatherings restrictions, or no one's traveling, or people are working from home. And in no short part, I think the energy sector has been massively impacted. I don't know if it may be a year or two before we know what the true changes are, but a lot of them look like they may be permanent. So, Billy, why don't we throw the first question to you? Since the COVID pandemic has started, how have you seen energy private equity change in just this short period of time?
Yeah, I mean, it's a loaded question. And when you talk about energy private equity investing and the models and how we go about building private companies, I don't think in the last year there's been a material change. You saw a certain business model from 2010 to 14 or 15, and there was a correction, there was a dislocation, prices collapsed, and the model really started to evolve around then. And by 16, you had seen a rapidly evolving model on how people invest in the energy business. Going from heavy, lease and drill, putting big acreage blocks together, drilling a few wells and flipping it to where now you have to own it and you have to generate real returns with it. I think over the last year, though, with the pandemic, what has changed or evolved is all the issues and things that we were contending with before has just been accelerated. And when I say contending, before, if you look back at 2019 as an example, from the beginning of 19 to the end of 19, the rig count in the U.S. fell from over 1,100 to below 800. Yet we averaged $57 oil. So there were, the business was evolving, and as PE firms, we were doing a lot of things in 2019 anyways. I think with the pandemic and the dramatic fall in prices and the outlook, when is demand going to come back, which we'll talk about over the next, several years, I think it's forced all of us to, if we had decisions we knew we were probably going to have to make, it's accelerated those decisions.
So Billy, it sounds like that the macro has not changed because of COVID, but rather it's accelerated it. Have you seen that change happen in any one particular vertical within oil and gas, or all across the board? Or how
it's all across the board. I mean, when you go, like what we look at, most of what we do is on the upstream side. And while, I like to make the analogy, people talk about how bad the oil and gas business has been beat up because of the pandemic. It's on CNBC every day, and there are a lot of talking heads who talk about it. But the reality is, if you were well hedged and reasonably leveraged, your revenues didn't go from X to 0.1X, and your cash flows go from X to negative X. I mean, we don't have that. If you were prepared for it and thought about it going in, sure, it hit you. But what we see is, revenues may be down 20%, 25%. Cash flows, depending on how well hedged you are, could be down 30, 40, 50%. But the assets are still generating cash, right? It's more the CapEx where there's a big hit. Now, if you take that through to the service side of the equation, then it's a different story, right? Because as the rig count falls, as the E&P CapEx falls off, then on the service side of the equation, they're in the business of servicing the oil and gas companies. And if the number of wells being drilled and the services required falls off a cliff, those businesses can be much more impacted, like airlines, restaurants, movie theaters, et cetera.
And so do you see this evolution of private equity energy that started over the last couple of years, but it's accelerated? Do you think we're coming to a resting spot as to what the new private equity energy space looks like? Or are we still in for a long ride as these trends continue?
Yeah, I mean, look, I think we were headed this way anyway. And when we started off, I said it's a loaded question. It's not just the pandemic. Our business has struggled for the last several years, and there have been numerous pressures on the business, whether it's generating returns, which I always think is first and foremost, to the pressure on the ESG side of the equation. You put all those together, and it's been a tough few years in our business. No capital markets, the A to Z. And so how do we come out of this? I think we just need to get to a point where, as a business, we were actually generating cash on cash rates of return that are acceptable and investors are happy with. And we haven't done it to this point.
So Jason, your family of funds covers E&P, midstream, and services. So as you're seeing the evolution of private equity in the energy space, what do you, as a leader of your firm, look for strategic changes, or how you may be nimble and modify your behavior or adapt to the new normal? What things have you looked at and decided to pursue, not looked at, et cetera?
Well, technically, Holt, we're not doing services. So we're doing midstream and midstream adjacent, so downstream. And then our E&P has traditionally been non-op. So we've been focused on how do we play in the core of the various shale plays as a capital provider more than an operator. And that's by intent to not compete with our midstream customers, but maybe be a complement to them. What we're seeing, so strategically, we're fortunate. I agree with what parts of what Billy said. I agree with everything Billy said, but parts of what Billy said are really impactful across the spectrum, and it's what's impacted what I would call public equity capital access, and even now on some level public debt capital access, which is this outspends your free cash flow, and one could argue very little corporate discipline from most of our public mid-cap to large cap E&P players. And whether or not the public institutional marketplace decided to vacate this space because of ESG or anti-hydrocarbon sentiment, or because it was a convenient excuse to offload underperforming portfolios, I'm not sure which. But when you're asking me how do we think strategically about what's going on in our portfolio, the first thing we're thinking about today is what is the impact of this transition year relative to how we monetize a traditional energy investment. And so one of the things Billy said about you got to be prepared to develop it and see it to the finish line. And that's a live within cash flow and capitalize your balance sheet correctly statement. But that's different than where PE was 6 years ago. And so if your portfolio wasn't prepared for that, you're going to have challenges. If it was, you're going to have duration issues. And duration, from our LP's perspective, is okay. As long as you're delivering a return on investment, duration is not an issue. But that's what I see. So I see some impacts that could be more permanent for PE and energy that deal with structure around life cycle and holding periods. But I also see opportunities. So one of the questions you asked was around, are we doing anything different? So yeah, we are not ignoring what I think is ultimately an all of the above approach to energy, which means renewables are on some level here to stay, or transitional energy is here to stay. And so what we're trying to do is just stay disciplined. So we're lower middle market. We have done some downstream adjacent investing. We have not done true renewable investing, and it's primarily because we haven't been able to see the returns that our LPs demand in that asset class. However, just like a lot of things in a downturn, some of these first owners of these businesses, I think, are impaired, and so there could be some opportunities that are as a result of this demand slowdown, where renewables assets or transitional energy assets make a lot of sense from what I would call an infrastructure perspective. So we're not officially allocating capital away from midstream, but we are taking a harder look at some of these transitional opportunities. We're also taking a harder look at pure operated E&P. So we recently brought on a new teammate to help us look at that, and we think there will be some non-core distress that happens that requires capital raising through asset sales, where we might be able to find some compelling buy opportunities. And in order to get our hands on some of the midstream assets, we may need to be positioned to also buy production. So those are some tangential changes to our business. But from a communications perspective to our LPs, we have been more of an energy infrastructure player for a while, conveniently masked in the phrase midstream, but it's really fixed assets with creditworthy counterparties, and fee for service is what we're looking for.
And you had mentioned that there's a number of opportunities, and you want to take advantage of those to the extent it makes sense. When you look out on the horizon, how long do you think this pandemic and post-pandemic and blip in the energy space will keep those opportunities, those unique opportunities, available?
I think we're in a tough 24-month period. I mean, who knows? Your guess is as good as mine if we're going to get a vaccine that people take that actually makes the economy open up again, or if we're going to have a second or third wave of the virus. I'm optimistic that the trends look good. I'm optimistic that you've got some analogs for demand recovery. China's one that's pretty aggressive, but so I'm not sure how much of that data is real, but there are analogs out there that would suggest that we can get back to the mean. There's a topic later in this around permanent demand destruction. I'll get into that later, but our perspective is you're going to have to be very disciplined. We do believe that the new normal here is going to be moderate growth and free cash flow conversion, and as opposed to aggressive growth like we saw before. And so if you're flipping to a model where return on equity from a public capital markets perspective and/or dividends are important, that capital discipline takes some time to execute, and it's going to take some time for people to believe in. But you're going to have to do those things, because ultimately we're going to need a healthy public energy space to exit our portfolios. Or at least we'd like to have that as an option to exit our portfolios.
Thank you.
Hey, Kyle, this one's for you. Switching to the companies in your portfolio, have you changed the way you think about leverage or capital structure for those companies?
Keith, certainly, I agree with a lot of comments from Jason and Billy on the previous question. I mean, our industry, it's been evolving. We were kind of in a growth at all cost phase through 2017, and really the industry flipped to more of a returns oriented and returns focused strategy kind of beginning in 2018. And I think that COVID has really accelerated that for people and made it all that more important. As far as leverage, I would tell you that one of our core tenets is maintaining low leverage inside of portfolio companies. That's part of our culture, part of it's because of our backgrounds, but, we've seen lots of cycles in this business, and we know that prices can move up and down quickly, and it's a hard business to run over a long period of time with a lot of leverage. And so we try our very best to employ a very moderate amount of leverage inside our E&P companies for that very reason. So, from that perspective, I would tell you that our strategy around leverage really hadn't changed, which is to be really conservative about it. It's not to say that we've never made a mistake or gotten into a situation where we have more leverage than we'd like, but generally speaking, we're pretty disciplined about maintaining extremely low leverage levels inside of our E&P companies. One thing that's definitely changed in the market related to leverage today is just the access to it, which I think is having an impact on the entire market. Certainly has an impact on asset valuations, kind of starting with, most of our portfolio companies that are private companies are primarily accessing leverage through what I'd call the traditional RBL market, where you have commercial banks, syndicates of commercial banks, really doing a reserve-based lending calculation and deciding how much leverage you're willing to put against producing assets. And, that business obviously has changed a lot over the last year. Again, I think it was changing prior to the coronavirus pandemic, but obviously that event dropped prices very quickly, put a lot of stress on balance sheets throughout the industry, especially smaller companies. And what you're seeing right now is a lot of those commercial lenders are suffering losses, frankly, like they've never seen before. And so, and what's supposed to be a low return, low risk business, you all of a sudden have these banks that are, facing some pretty significant losses. In addition to that, they have some of the, broader ESG pressures around lending to the energy business. And you kind of have a lot of forces that I think are driving some of the participants out of that market. And, that's going to do two things. It's going to drive that cost of capital up somewhat. And then I think it's just going to make it more scarce in general. And so, the ability to go syndicate large amounts of capital in that format is in question today. And, I think that's having an impact on the A&D market, the ability to monetize assets, the ability to raise capital around assets. And frankly, I think it's an opportunity for all of us here on the phone because, we do have access to equity capital. And again, we're not typically looking to capitalize these businesses extremely aggressively anyways. And so the ability to use that equity capital to go capture assets in a market that maybe doesn't have quite as much support from the RBL side, could be an opportunity for those that have access to equity capital as assets begin to move.
Thanks, Kyle. Billy, back to you, and I think you touched on this a little bit, but I guess in regards to generalist investors kind of running for the exits, is there a way in the current fundraising environment to bring those investors back into the PE space?
Yeah, and I think there are a couple of camps when it comes to the investors who invest in our funds and private equity funds. There's the camp that, well, there are really three. There's a camp that I think they either have or they plan to abandon investing in fossil fuels, and that's happened. There's another group that sits somewhere in the middle where they're evaluating it. Their constituents are forcing them to think through these things differently. That puts a lot of pressure on our firms and how we have to respond to that. A lot more Q&A, a lot more reporting on our end. But I think, big picture, they want to be smart about it, and they'll be there if the returns are there. And then there's another group of investors, probably in the minority today, who are opportunistic. They look at this as a real trough in the cycle for all the things we've talked about here today, namely where there's no capital markets, whether you're talking about RBLs, high yield, equity markets. I mean, there's really some private equity capital out there, and there's not even a ton of that. I mean, we've seen in our business, a large number of people pull back or pull out of deploying new capital. So there are institutions out there that look to the private equity world and the model, and us on the, on this call here today, and think this is a good time to put money to work because there's not a lot of money chasing deals. Big picture with all this, there's nothing we can do about the institutions who are going to bail out because of the ESG movement and issues. That's going to happen. But I think for the rest of them, the bigger issue and what drives all this are the returns. And if we generate returns, they'll be there and they'll come back and they'll invest in funds, maybe not to the scale, the size that they have in the past, but they'll be there. We just have to generate the returns.
Jason, you had said something earlier that I wanted to circle back on based upon Billy's comment. You had said you're constantly interfacing with your investors, with your LPs during this time. And based on what Billy said, it seems that you have a wide variety of LPs and each one may sit in a different position or have different pressures on them as well because COVID is affecting them. What are you seeing generically from your LP investor base? What are they saying to you? What are they messaging to you? How are they wanting you to navigate this?
It's a good question. It starts with communication. So, we've been overly communicative with our LPs during this crisis and making sure we understand what their hot button issues were. So, for example, in the second quarter, when we were really early in the shutdown, we had a lot of LPs that were, signaling, hey, don't do a deal right now, please. I don't know what my liquidity is, and it really wasn't that bad, but it was, let's just make sure we're communicating. And I can appreciate that because it was a pretty tumultuous time in the market. But as we've stabilized, and I'll kind of echo what Billy just said. Most of our LPs are either in the middle camp or they're believers in the fact that hydrocarbons are going to be tough to replace, at least in their careers over the next 10 years of investment cycle. And so it's really about returns and investment discipline. And so our perspective is we're going to look at things that are new. Some of these things are very similar to what we've underwritten historically. They're not necessarily new technologies or have that kind of adoption risk to it, but it just has to generate a return. And whether that return is purely on its merits or requires a tax credit or some sort of subsidy is relevant. And we need to understand those kinds of things as we focus on new opportunities. But our LPs are fortunately not feeling the ESG pressure to abandon fossil fuels, but they're very clearly focusing on us to maintain discipline and deliver the return expectations that we raise the capital on, which for us we're trying to be low to mid 20s if possible, and that's not easy to do in this market. It's challenging. However, I want to echo something else that that was said. We're not so as we look at deploying capital, in the traditional format, our LPs are, in my mind, they're not looking for us to race to the outcome, to the end game. They're looking for us to try to provide some level of thought leadership to them, some level of comfort to them, but they're also everyone is fairly afraid of the pacing of this recovery and highly suspicious of very high conviction in anything that has to do with COVID timing or demand recurring or reverting to the mean. And so our perspective is you kind of know when you see it. So we're being patient. We're fortunate to have some dry powder, and Billy said it well. There's not as much private equity capital out there as you think. In fact, we did some work on this. It's the lowest point in the last 6 years for available dry powder. A big chunk of the dry powder that's out there is from 2017 and prior vintage firms. And we all know that a lot of that capital is very highly likely is spoken for. And so it's not technically available. So I think if you play this cycle out, this could be a very good time to be patient. And I think our available capital is going to have a pretty significant premium.
Each one of our panelists has talked about being opportunistic, being thoughtful, staying the course, and utilizing their dry powder when appropriate. Kyle, A&D has been meager at best. Obviously, there's bankruptcy, acquisitions, et cetera, but it's been a very slow market on the A&D side. What do you like when you look in your windshield? When do you think that A&D will be back to some sort of when people will quit being afraid to catch a falling knife or not be nervous about being opposite a counterparty risk. When do you think A&D will come back with some consistency, both in the private and public markets?
Yeah, no, it's a great question. It certainly hasn't been a very robust period for A&D. Obviously, deals are easiest to do when the buyer and seller can see close to eye. And in a really volatile environment like we've had with COVID, it's very difficult for buyers and sellers to come together. And so I think that, some time in a new environment always helps. I think the primary issue with A&D specifically in today's market is when you're hanging around $40 a barrel, it's very difficult to pay a lot for development upside in these companies. But if you're an existing owner of assets and you've got a valuable asset that you think requires future development, and you think there's an economic opportunity at some point to go develop those assets in the future, and you have runway to what's potentially a brighter day in the future, you're very hesitant to sell your asset only for the cash flow it's currently producing and not receive any value for those future development locations, right? Which makes total logical sense. But as a buyer, it's very hard to underwrite a bunch of value for those future locations when you can't, at the current strip, kind of pencil out making a really significant return on that future development. So, I think that a lot of things can change in that underwriting. Clearly, time for that new market environment to settle in the mind of both the buyer and the seller can be helpful. Billy could probably speak to this more intelligently than me because he's got more service experience, but I think that as the service costs and the service industry adjusts to the new environment, that certainly can change the margins on the upstream side and help with some of that underwriting of those future locations. But, I think that it will take a while. Clearly the equity capital markets have not been supportive of public companies making acquisitions for some period of time. We talked about how we kind of exited. There was that growth at all costs phase really up to 2017 almost, where the equity market was very supportive of public companies raising equity to go bolt in acreage, bolt on assets, bolt in growth opportunities, because the market was very focused on growth. But since that period of time, the market dynamic has really changed, and the investors said, show me the returns. And most of the capital has been focused on development. And so I think, until we can show significant returns inside these assets and deliver that back to investors, there won't be a robust amount of support from the public equity market. And, buyers and sellers are going to need to come together based on that common view of the assets.
All right, so everybody says the lawyers are always gloom and doom. So let me put on my gloom and doom hat, Billy, and give you a scenario. Despite everybody's best efforts, we've been unable to come up with a vaccine. And so what you've seen in your rearview mirror the last 6 months is what is in your windshield for the next 6 months to a year. Tell me how that A&D market evolves or what happens.
Yeah, I mean, I agree with what Kyle just said, a lot of what he just said. And I don't think that market comes back till we get $55+ oil, and until we really see demand come back, and that we're getting through the pandemic. I don't see how we get $55 oil or better, even with 250, 300 rigs running. So if you were to say what do I think is going to happen in the next year? The first thing I'd say is my crystal ball is about as hazy as it's ever been. It's just really hard to know. Predicting in this world is crazy. But I think if I'd pick one of two routes, I'd either say the next year ends up being as dead as it's been the last 6 to 9 months, or finally the lenders decide, let's punt out of this asset class. The restructurings we've been involved with over the last 6 to 9 months, we're tired and we want to get out. And then you see those assets turn over. Because I'd say the biggest frustration for us over the last 6 to 9 months hasn't been a lack of looking at lots of distressed opportunities. It's been that literally everyone except one that we've participated in, the fulcrum security, which is whether it's senior or some sort of second lien or junior debt, where really the inflection point is in the capital structure, they've been the bidder to keep the assets. And we've seen it at all levels. We've seen the second lien groups come in and basically in bankruptcy auctions, they're the highest bidder and they show up last minute. We've seen the banks, the RBL do the same. So, that part's been, I would say from an A&D perspective, frustrating because I can name, almost a dozen that we've been involved with and only one that we know of where somebody actually emerged as a buyer of assets that wasn't in the fulcrum security in the company already.
Interesting.
Kyle, this one's for you. I guess in a lot of A&D processes right now, you see a real wide bid-ask spread. And the question is, have you guys come up with any creative bid structures or financing structures to narrow that bid-ask spread? And if so, maybe kind of elaborate on that a little bit.
Sure, Keith. Clearly, I think there's a bunch of different strategies that can be used, right? Billy mentioned $55 oil being a place where he thinks, and I agree with him, buyers and sellers could be more constructive. So, perhaps you can build in some type of earnout related to oil price, related to certain milestones to help bridge that gap. I think another thing that we're open to and have discussed a lot with different parties is trying to be a little bit more creative on the structure side. Obviously, what we typically do is common equity, but I think that sometimes you can utilize preferred structures and other interesting structures in order to try to bridge that gap. There's a public Permian company that recently did a pretty creative deal that involved selling an override and also layering in some additional capital that was senior to parts of the capital stack and junior to others. So I do think that, perhaps in some of these times, structure can be helpful. So you don't have to come together and have an exact meeting of the minds on what the exact value of the asset is at any given moment.
Got it. Jason, one for you. There's some people that say that the core plays are the only plays that work in this price environment. How do you, as a private equity investor, think about accessing the core of major plays as plays get more mature?
It's a good question. I might start by saying I'm not sure I agree that the core plays are the only plays that work. I think if you're purely going to look at it from a greenfield or a new growth perspective, that's probably true. But I think we are seeing some interesting opportunities to buy non-core assets that are PDP kind of blow down math, kind of bond math, no terminal value. And if you're thinking about the world from a cash on cash perspective and a yield perspective, there can be some pretty interesting opportunities there. So we're not just focused on the core, and we're also looking downstream too. So I think there's some nichiness in there that's good. But if you're trying to play the core, where we've been successful, quite frankly, is on most cases is because we're not just focusing on the middle market, but it's the lower middle market. So going somewhere small where you're not necessarily competing with a big midstream player trying to defend their turf, and a lot of times bringing drilling capital to the table with our non-op fund as part of that. So we're solving two problems at the same time for our counterparty. And but having said that, I do agree fundamentally, if you're going to do anything gathering and processing, or quite frankly transmission oriented, it all starts with the rock. So if you don't have the ability to have at least confidence in some element of reserve replacement or growth, it's pretty hard to see your way to being excited about capital deployment. So, but we've also found some nichiness. So we've found some little niche. We've got a little play in Scurry County that nobody was really paying attention to because, quite frankly, it's small. But there's 4 rigs behind our system right now, and that's all we need. So starting small sometimes can also kind of keep you in the game because you don't need as much activity to make it work. But it's a really hard thing to do, and I think right now we've been in somewhat advantage just because of the down cycle that we're in. If prices get back to $55, $60, somewhere in that range, that's going to change the game for being able to uncover even a small asset that's not going to be looked at by a lot of people. So today that's how we've done it. But I also think that there's going to be some opportunities in the next 24 months if we're all right, and that's probably where I'd put it on a probability basis. I think we're more likely to be stagnant than we are to be back in accelerated growth mode over the next 24 months. And Billy made a good point. Cal's made some good points too, but the concept of where the banks are today and their willingness to actually write off some of their position to try to facilitate, a basis reset in an asset, that could be the next way to get into some of these core plays if it actually happens. And it's been very frustrating to watch because it should happen. We need a full basis reset across the whole spectrum of upstream and midstream in some of these basins. And I just don't know that we can fully get there if the banks aren't willing to also write down some of their asset value.
Getting into the competitive landscape, this question's for you, Billy. Since there's not exactly a large abundance of high quality A&D opportunities on the market right now, have you seen increased competition for small and mid-market deals?
I'd answer that by saying not really, but the caveat is size. Within that spectrum, to the point we've all kind of made here that the bank market isn't there; it's gone. The amount of equity capital available is a lot less than what most people think. Given those two things, I'd bifurcate. If it's a sub $10 million deal, sure. I mean, the small deals like that, there are a lot of people can cut an all equity check. But once you start getting to deals in the 10, 15, $20 million range, the people who can cut equity checks to get those deals done, it drops off very rapidly. And so, what we've seen is there's a lot less competition for those deals. There may be a few people there, and if somebody who doesn't have the financing gets in the mix and they happen to be the high bidder, those deals take forever to close. I mean, we've seen deals at 9, 10, 11, 12 months to close because people are trying to round up, 15 or $20 million, and they're just hard to do. So yeah, not really is the simple answer. I think it's from a competitive perspective, it's probably as good as it's ever been in our business because of the lack of capital.
You'd mentioned rounding up people to get money. One of the things that some people proselytize as the darling of the industry and the new way to go, and other people say gloom and doom, are special purpose acquisition companies or SPACs. Kyle, give me your thought about SPACs and what role they currently play and what you see them playing in the energy space in the future.
Sure. Obviously, SPACs have been around for a long time. And they have, taken a spotlight in the media here lately. There's been a lot of SPACs across a lot of different industries. I think some of the aspects of COVID make the kind of traditional IPO route of marketing and roadshow, a little bit more challenging. And so you have some premature businesses out there that have taken advantage of these SPACs that are set up with kind of some existing public financing in place as a way to get public quickly. And we do see some of the different energy sponsors going out there and forming SPACs. Primarily, I haven't seen any of them formed for, traditional oil and gas, but I think primarily being formed to take advantage of what's happening in the energy transition space. We're not one of those companies. We haven't delved into that market. I do think to compare and contrast today's SPAC with the SPAC of maybe 10 years ago, the SPACs have gotten to be much more competitive for investors because of the way that there's kind of multiple rounds of financing. It dilutes essentially the ending management ownership down to a pretty small level. And I think, that structure can make a lot of sense for investors and management alike. So, hopefully one thing that it helps bring is an additional liquidity point for assets as they mature, as we've all talked about. There's kind of, it's hard to get deals done. There's a lack of liquidity out there. So I think it's an additional avenue for liquidity, albeit currently probably more focused on the energy transition space than the traditional E&P space.
So Jason, when we're talking about competition, we talk about investors, et cetera, oftentimes a core investor in various private equity funds are the family offices. And from my perspective, I've seen family offices, in addition to continue to investing in funds, they've also become independently more active in the energy space. How have you seen the role of family offices in the energy space change? And do you see them as having an impact from a competitive perspective, both for talent as well as assets going forward?
That's an interesting question, and not really. We really have not seen any competition on either front from family offices, either for investment personnel talent or operating talent, for that matter, to competing on deal opportunities. I've certainly heard about family offices being more active in some of the more the A&D space, especially families that are familiar with hydrocarbons and hydrocarbon risk, trying to take advantage of this timing opportunity to buy either minerals or production. But we really have not seen any family office competition on anything around the capital equation that we're looking at. So 50 to 150 million plus equity checks for a single deal. We're just not seeing family office competition in that.
And Bill, you had mentioned availability of cash for small deals, large deals. Do you see family offices being more competitive in your space on the MP side or not?
Yeah, it's hit and miss. I mean, you'll see them on certain deals if the asset makes sense, but you don't see them a lot.
Okay, moving on to our energy transition segment. Billy, this one's for you. Transition in energy markets is an interesting theme for private equity that has different applications depending upon the context. I guess to that extent, will energy transition from oil and gas to renewables and ESG focused models? Maybe talk a little bit about that, how you see that transition going, and based on your answer, how will that affect your business?
Yeah, I mean, to me, it's the question of, post-pandemic, when do we get back to, a normalized world? And then it's an easier question to answer, because I've always been a big believer that we need everything, right? We need solar, we need wind, we need natural gas, we need oil, we even need coal. There's not an energy agency globally that has coal going to zero in our lifetime. In fact, most of them, internationally, coal consumption, from a power generation perspective, most of the agencies believe globally it'll only fall down into the 25-30% range, and here in the US, somewhere between 10 and 20%. So it's not going away. I think we need everything. So what does that mean? Great question. We could spend hours on this, but I think big picture, we don't feel over the long run that all of this is going to be, have a major impact on the oil and natural gas business. But now you have to break those two down, right? Because if we talk about energy transition as being electric vehicles as part of the equation, let's say even the rosiest scenarios that you see for electric vehicles, now it's 2% of car sales. And if you get even the rosiest projections, the question I have is, well, you got to power those things. So where's the power coming from? And there's only so much solar and wind. So is it become a natural gas game? Sure, there'll be impacts if EV growth is much greater than we all think on oil demand, which could mute oil prices over the long term. But I think natural gas benefits from that. So again, big picture, I think we need everything. I think we all have to be smart and understand where the economics are for both oil, gas, solar, wind, and where we fit in the cost structure.
Got it. Jason, this one's for you. And in regards to transition and LP interest and demands, can you shed some light on any new LP conversations coming your way in regards to portfolio holdings and holding periods, fees and performance, access to management, and market intelligence?
Talk about a loaded question. So let me start with the first part of that. It kind of ties in, since this is a transition piece. We're in the same exact boat that Billy is. It's an all of the above approach. You can't get there with just renewables in any format. And the backdrop of that, our LPs are pretty comfortable underwriting that position. And so for them and how we think about transitions, it's really been, hey, stick to your discipline on core returns, stick to your discipline on fundamental kind of energy infrastructure, and we'll let you guys be the experts on whether or not you think you should do it. Having said that, some of what's happening in this market, clearly, whether it's permanent, kind of going back to the three groups of LPs that Billy, highlighted earlier, those that are divesting of fossil fuels, those that are in the middle, and those that are still comfortable owning it and focused on returns. There is a component of capital access that's driven what I think a durational equation into traditional hydrocarbon investing, at least in the funds that we currently have active. Maybe in future funds, this sort of reverts to the mean. But right now we're, in our opinion, dealing with what could be an extension of duration, just because it's going to be harder to exit and monetize some of these positions in this energy capital market. And so we haven't had any breakthroughs with our LPs. We haven't needed to do that yet, but I could see where, if big chunks of our portfolio, or if the private equity energy market in general was transitioning into a materially longer average life, that you're going to start having discontent across your management teams relative to how their incentive structures are set up, relative to how our LPs incentivize us. And so that's probably the biggest elephant in the room if we really end up in a long tail position. Fortunately, we're not there yet. But it's also, if you've done your job right and you've capitalized your business right, and you're generating ROIC for your LPs in your portfolio, those are the kinds of things that you should be able to work through to make it work. You can't run these businesses without management teams. So hopefully we don't get there, but that's probably been the biggest conversation that we've had with our LPs, is what happens if our whole portfolio life gets extended 4 or 5 years beyond what we normally would have thought.
Got it.
With the focus on emerging renewables and ESG, et cetera, Kyle, has that caused you guys to consider adjusting your deal sources and deal flow? And if so, how so, and how long do you think it takes to accomplish that? If not really, then why not?
I guess on this topic, first of all, I'd say I totally agree with Jason and Billy. I mean, our perspective is that, the energy demands of this globe are massive, and they're going to continue to be big today, tomorrow, into the future. As the population continues to expand, and as people, move out of poverty and into a developed lifestyle, they're going to consume more energy, and it's going to take really all the different sources of energy that we can muster to provide that energy to the world. And so we think that hydrocarbons are going to play a big role in that for many years to come. Obviously, COVID has impacted oil demand. We do think that demand will come back to the 100 million barrels a day or so it was running, and continue to grow beyond that. Having said that, obviously, you can't pick up the paper without seeing that the world's changing. And, there is a big focus on ESG, on renewables, on can we find less hydrocarbon intense ways to power the globe. And so I think that, we do think there's an opportunity right now in kind of this energy transition. It's primarily on the power side. We've touched a little bit on electric vehicles. Obviously, the U.S. power grid is a big grid. It's transitioned pretty dramatically over the last decade away from coal and over to natural gas as the primary base fuel. You still do have a component of coal, but natural gas has made, very big strides. And so we think that's going to continue to play a big role. And we also believe that going forward, that grid will continue to have more and more renewable wind, solar generation on the grid, along with battery storage to help supplement that and level out those power demands. And I think part of that is because those sources of power supply have come way down the cost scale over the last decade. And the other piece of it is, you have the vast majority of states have mandated some sort of transition into renewable power. And so there is going to be quite a bit of capital spent to go make that effort a reality. And, we think that there will be opportunity there. And so we continue to believe there's opportunity in the oil and gas space, in the midstream space. And we also think that there is opportunity going forward to take part of that energy transition as well.
The COVID world and what it's done to our economy and what it's done for our day-to-day life has thrown this world into a crazy Sunday. And the cherry on top of that Sunday probably is the pending November 3rd elections. And people seem to say that, the impact of this could go on for decades, if not generations. And without drawing anybody off sides, all we really need to do is focus in on what it looks like, what the impact of this has on the energy space and the private equity world more particularly. So Billy, I'll throw you this hot potato. How have you guys been impacted by the pending election over the last 6 months and analyzed it and made your actions according to it? And then talk to me, wake up, it's November 4th and Trump has been reelected. How do you proceed? Or Biden has been elected. How do you proceed?
Yeah, I mean, I would start by these are all good, tough questions, kind of fun to debate. I would start by saying, from a, how are we going to do things with few specific exceptions? It doesn't change how we go about things, and remember, for the last 3.5, 4 years, we've had an administration that's been about as friendly as we've ever seen to our business. Yet we've had this huge ESG push that has been driven in large part by the companies themselves and the capital markets. So, and you see the pressure going on in Texas today to reduce and eliminate, flaring, and that's not being done by the current administration. So these things are happening regardless of who's in office. There are a few specific things though that we look at, and I think now there's either halt, pause, depending on where you sit. Other people are rushing to get things done, and the biggest thing for us is really federal acreage, because nobody knows what will happen with federal acreage. And you hear, the federal government's not going to do anything if Biden's elected and the Democrats win Congress. Well, or they're not going to take permits away, drilling permits away. Well, drilling permits only last so long. And if we don't have real price recovery in the next year or two, you won't be able to drill all the drilling permits. So then what happens after that? So there are a lot of things, whether you're on the E&P side or midstream side of the equation, you have to think about those issues longer term. So I'd say the biggest concern for us is the federal acreage side. The flip of that is if you're a company and you don't have much federal acreage, you feel like if something does happen negatively towards those assets, to the federal acreage assets, yours became that much more valuable. So there's not always clear-cut industry winner and losers. It can be very company specific too.
And Jason, do you look at that any differently with the midstream lens on, or is it kind of the same approach?
It's really a maybe slightly modified. I mean, we think under a Biden administration, permitting for new construction will be more difficult, especially for anything that has, interstate components. But from a core risk, going back to what we said earlier about it all starts with the rock, 100% in Billy's camp. It's a federal acreage issue. There's a pretty hard line, at least we think, from a case law perspective, on banning fracking. So we really think it's a federal acreage, either new lease or permitting game. And then you've got to marry that against some states that are blue that, quite frankly, drive a lot of their annual revenue from ad valorem tax. And so it's a pretty touchy subject. I think it's messy.
Hey, Kyle, kind of a related question. Does the election factor into your private equity underwriting process and energy or any other sectors that are relevant to your business?
Keith, I would echo some of the comments of Jason and Billy. I think the primary focus is on the federal acreage. I do think that, clearly with the change in administration, there's risk to the ability to go out and develop those assets in any timely manner. I also agree. I don't think there will be a ban on fracking. I think that, these political issues they're big political issues. They're used in elections to get voters' attention. But I think the odds of a fracking ban are extremely low. However, I do think, inside these bureaucracies, you have people and you have policies, and they have the ability to slow down development, make things harder, make things more expensive, and essentially impact the economics. So that's probably the biggest place of our focus.
Jason, you might have covered this already, but would a Biden victory change your views or increase your focus on the energy transition, renewables, and ESG?
I think it's kind of hard to tell where the actual policy is going to come out. If it's as far towards a Green New Deal as potentially advertised, then I do think you could have some stroke of the pen risk in new construction or greenfield projects. The flip side of that is I don't know. I think it's almost every Democratic administration has been very bullish for commodity prices, and anything close to a Green New Deal is going to be extremely bullish for pricing. So, I think we just have to play it by ear. We're certainly not moving rapidly to try to close anything in front of the election. I'd kind of like to know where we stand before making any major commitments at this point. We kind of said this already. It's got to be an all of the above approach, and so there's nothing like the case study of California to show what unfortunately, a lot of these policies are really just regressive taxes. I mean, they disproportionately impact the lower income communities, and it's a real issue. And if we're really going to mandate a lot of this stuff, it's going to have some trickle down impacts that I think are pretty meaningful and aren't necessarily being articulated in a way that people understand. And so all of that to us points to higher prices. So regulation that's constrictive combined with no capital access with a depleting asset class, 2 years from now, I think 55 feels pretty good.
So I think the gray hair on all of our heads shows us that we've been through cycles before, right? And this is, at the end of the day, this is a limited resource, powers more things on the face of the planet than anything else. There are emerging countries that rely on this to reach second and third, first world status. Billy, let's change it to the positive. At some point, this market will come back. Walk me through the market recovery and what it looks like, both on the macro level, global, then with respect to energy private equity.
Yeah, I mean, the bullish side, which look, we do believe, otherwise we wouldn't be investing the way we are. So we do think that the market's going to come back, but we think it's probably 12 to 24 months before people start behaving like they used to, right? And I think there's going to be a lot that we learn. We're still only 6 or 7 months into this. So there's going to be a lot that we learn over the next 12 months. Do we come up with a cure, which I personally think is more important than a vaccine, that if there's a real treatment that works? And do people get comfortable getting back on planes and living life as they did 12 month ago? That's probably going to take at least 12, more like 24 months. But with that, we're going to have a tough pricing regime with oil in particular over the next 24 months, which means the rig count isn't going to get a whole lot better. And to Jason's point, talking about declines in a depleting asset, a low rig count only means one thing for production, and it's going down. And so where does that put us as people start getting back to their normal lives? Demand goes back up to where it was. We get back on a normalized trajectory, yet we're caught short again. And so, when I look out 24 to 48 months, it's hard to see exactly when in there, but thinking out 4 years and that we won't have some sort of price spike where we get caught short on supply, I'd be surprised if that didn't happen.
So Billy has given me 2 to 4 years, Kyle. What do you think the commodity price is going to look like in the next 12 to 18 months?
I thought you were going to ask me to give you a 1 to 5 year estimate. I agree with Billy's comments. I mean, look, we saw an unprecedented demand shock, right? I mean, oil demand, 101 million barrels a day. It averaged 79 million barrels a day in April. That was kind of the bottom. And you had, as you had demand racing down, supply followed pretty quickly, right? OPEC moved in, announced a 9.7 million barrel a day cut in April. Obviously, we had producers shutting in volumes in the U.S. and elsewhere to the tune of several million barrels a day of volume. We've seen the rig count race down really to unprecedented levels, 250 rigs approximately running. And so, if you think about the kind of the rosy picture in the bull case, demand's already recovered to over 90 million barrels a day, right? And when we had a world that was completely locked in a pandemic on lockdown and we were still consuming 80 million barrels of oil a day, that's pretty impressive. Now we're already back above 90 million barrels a day of demand. Jet fuel is one of the primary things that's still down. Domestic flights are down about 50%. International travel is down about 70%. And so those still have a ways to come back. But, by and large, people would like to get back to their normal lives, and people still consume quite a bit of oil on a day-to-day basis. We've built up an inventory that we're going to have to work off because that demand fell faster than supply could respond. And so inventory swelled by about 500 million barrels, which we're already starting to work through. I think some of the big things to watch going forward are, how quickly are we working down that inventory back to normal levels? Lots of analysts think that'll happen by the year end 21. What does OPEC do? How long do they keep those barrels off the market? When do they bring those barrels back on? And then coronavirus, right? I mean, do we go into we have a relapse into kind of a second wave, or do we have a virus or a cure more quickly? But I think, as you watch those three things, that holds part of the answer. But I believe, like Billy and Jason, that there will be another rebound in prices, and clearly there's a very big lack of capital investment today, and at some point that will come home to roost. These things are cyclical. U.S. production's on a pretty steep decline, and frankly, we've represented really 100% of the oil production growth for the globe over the last 7 or 8 years. We kind of have been the growth. So if we're shrinking, you think the overall supply is going to be flat or shrinking, and as long as demand returns, we'll be back in equilibrium at some point in time.
Jason, last question for you. How long do you think before energy demand returns to pre-COVID levels?
You asked me to be as specific as possible in this question, Keith.
Right.
The thing that I'm focused on is what I think is really impacted by COVID. And to me, that's corporate air travel and stay-at-home workers, right? So are you commuting to work, which is really a light vehicle consumption issue. And we did a lot of research on this for this call on some of our sources. And so kind of collecting IHS and McKinsey, the worst case scenario for going back to work, 35% of the global workforce could work from home by their estimate. And if they all did that and they just never went back to work, that would represent about 3.8 million barrels a day of crude demand. And the worst case estimate for corporate air travel is a permanent reduction of 15%. So we only get back to 85%. We never recover fully. And surprisingly, that only has a 300,000 barrel a day impact. So that's 4.1 million barrels a day of sort of permanent demand destruction. And if you revert to the mean growth rate for the last 100 years, it's somewhere between 1.2 and 1.4% annual growth in crude demand. So realistically, takes you 2.5 years maybe, depending on what your starting barrel number is. If it's 95, it's longer. If it's 98, it's 2 years, and you're right back to 102 million barrels of demand. So I think it's more optimistic than that, because we are Tailwater is part of that 35%, and we're already at 75% capacity. So, my estimation is the biggest thing for demand recovery today is going to be confidence in the virus, and whether it's a vaccine or a cure, or quite simply just, maybe the virus losing some of its potency. That's what it's going to really take for people to get back. Having said that, there's some element of the statistics that baffle me relative to the risk profile that we're taking on as a country in terms of restarting the economy. And no one likes to put a price on human life, but we are certainly charging ourselves and future generations a lot of money for this current pandemic. And I hope we're right, but to me, it's all about the restart. So that's a long-winded answer to, I think it's the end of 21. I think it's going to be better than the pundits say, and I think we're going to see some benefits to some form of medical, at least cure, maybe not cure, but help to ease this along and reduce the death rates. And by mid-21, this thing's, we're fully back in action. You have to remember how strong the global economy was, specifically U.S. economy, just in February. So, it's pretty amazing to see what happened so quickly, but we are somewhat optimistic that we're kind of back to normal, maybe Q1 22.
Well, good. Well, thanks, guys. Great discussion today. Appreciate everyone's participation. Thanks to all the panelists. Hull, thanks for co-hosting this with me. This concludes Navigating the PE Landscape During a Pandemic and Beyond, a Stephens Investment Banking webinar in collaboration with Thompson and Knight. Be sure to follow the rest of our virtual thought leadership series online. Have a great day. Thanks, guys.
Stephens, an independent financial services firm, has a long history in the energy markets and is highly regarded for its sector expertise and prudent client advice. Over the past decade, Stephens has continued to affirm its industry focus, growing its dedicated investment banking team to 15 professionals and completing 167 transactions to date. The group's coverage includes the exploration and production, master limited partnerships, and oil field services sectors. The combined knowledge of the energy team enables Stephens to provide clients an unmatched level of investment banking service, including mergers and acquisitions advisory, fairness opinions, and public and private debt and equity offerings. Established in 1887, Thompson and Knight is a full-service law firm with more than 300 attorneys in its Texas and New York offices, as well as international offices in Mexico, North Africa, and Europe. For more than 120 years, the firm has counseled oil, gas, and energy industry clients through highs and lows in the market. Those who explore, develop, produce, finance, store, market, transport, and process energy resources. Thompson and Knight is one of the only large law firms in the United States with a separate oil and gas practice group, and more than 85% of the firm's attorneys have worked on energy industry matters. Thompson and Knight has more attorneys listed in the Best Lawyers in America in 2020 for oil and gas than any other firm in the United States, and the firm is also proud to be recognized among the top firms in Texas for corporate M&A in Chambers USA 2020, which notes that the firm is frequently sought by private equity funds and possesses extensive experience in fund formation matters.